So this is the topics for today's class. Installment notes. So what is the installment note? You can see the definition. And installment note is a debt. So an installment note is a debt. Debt means this is your liability. Okay, so an installment note is a note or debt. It is your liability that requires the borrower, because you are the borrower, so it is your liability, to make equal periodic payments to the lender. So lender means who will give you the loan, right? So an installment note. So our topic is here, installment note. So an installment note is a note, and it is your debt, means it is your liability. And as you are a borrower, you have to pay this liability through some equal periodic payments. You have to pay your liability through some equal periodic payments to the lender, okay, for the term of the note. For the term of the note. Anyway, so example. Notes payable. That means the principal amount. Amount is $100,000. So this money you borrow today. Today you borrow this money. This is your liability. So notes payable principal amount is $100,000. You borrow this money today, right? But you have to pay this money to the lender. You have to pay this money to the lender to make equal periodic payments. So out of the equal periodic payments, so we assume that this is principal amount and term of the note is 5 years. So this is to point. So term of the note is 5 years and you borrow $100,000. So year one, so as it is 5 years loan, we make it year 5. They say that whenever you are going to pay money, so year one, December 31st. So when you are going to pay this money every year, December 31st. And you borrow your money today, we assume that you borrow this money year one, January 1st. So you borrow $100,000 when it is year one, right? Year one, and when year one, it is the beginning of the year. It is the beginning of the year. You understand? Now, when you are going to pay this loan, you are going to make equal periodic payments. Equal periodic payments. And when you are going to pay this money, you are going to pay this money at the end of every year. At the end of every year. So you are going to pay this money at the end of every year. And I assume that it is $20,000. $20,000. Or maybe $30,000. Make it easy, 20,000. Okay, so $20,000 every year, we are going to pay this. Something like this. So easy example is this. Okay, so you borrow money $100,000, but this is our equal installment. And at the end of year 5, okay, at the end of year 5, that means at the end of year 5, after paying all the installments, okay, after paying all the installments, you will not have any liability. So when you make your last payments, so you will not have any liability. It means that notes payable is $0. Notes payable is $0 at the end of year 5. Notes payable $0 at the end of year 5, and this is beginning of year 1. Today notes payable is $100. So try to understand. This is year 1. Okay, this is year 1, and year 1, January 1st. What is the amount of notes payable? What is the amount of your liability? Your liability is $100,000, right? Today is year 1, January 1st. You borrow $100,000. Now at the end of every year, you are going to make equal payment. Okay. After making equal payment at the end of year 5, you will not have any liability. Your notes payable amount should be 0. So it means that this $100,000 is called beginning carrying value of note. This is the beginning carrying value of note. Beginning carrying value of note is $100,000, and is the ending carrying value of note at the end of year 5. Okay, ending carrying value of note at the end of year 5 is $0. So this is the story. This is the story of an installment note, right? So every equal payments here, you can see that every equal payment. So whenever you pay $25,000, this money is the combination of two components. So when you pay some money, when you pay this money, $25,000, right? This payment includes two components. One is called principal amount plus another amount is called interest expense. Do you understand? So you pay $25,000. This amount includes principal amount of note, right? Principal amount of note and some part is the interest expense. So the problem is your question do not have this information. Your question do not have how much you paid for the principal amount, okay, and how much you paid for the interest expense. This two is not given. This two is not given. So we only know how much the total amount we paid. We only know this information, how much the total amount we paid, it is only given. Okay, so we have to calculate this number. We have to calculate this number for every year. Now I give you another information. So principal amount is $100,000, and we know that the term of the note is 5 years. And for example, interest expense, interest rate is 5%. For example, interest expense rate is 5%. So if this is the story, your notes is $100,000, it is 5 years and interest rate is 5%. So here, that means every year we know this information, 5%. So this 5% interest, this is the rate, this is the not the dollar amount. Try to understand. We need dollar amount. Question give you rate, okay? Question give you rate, but we are going to use this rate. We are going to use this rate. Okay, we are going to use this rate for dollar amount, right? Yes. So this is the question. This is the question. Now, year one. This is given in the question. Question tell you paid $25,000 first installment. Okay. Question tell you that this $25,000 is the first installment. Question tell you that interest expense rate is 5%. Now, what is the dollar amount of principal amount? What is the dollar amount of interest expense? So which missing amount you have to calculate first? Do you understand? Year one, we have two missing amount, right? We have two missing amount. One is principal amount, we have question mark. We have interest expense, we have question mark, right? And these two together is $25,000. And question give you a clue that interest expense rate is 5%. So which one you have to calculate first? Interest expense, okay? Okay, interest expense. For example, we calculate interest expense. For example, random number, okay? It is $4,000, for example. Just a random number I put. We calculate $4,000 is the interest expense. If $4,000 is the interest expense, then what is the principal amount here? $21,000, right? Then $21,000 is the interest expense. So if we can calculate $4,000 interest expense dollar amount, then we know the total amount. The total is $25,000. Total is $25,000. If $4,000 is the interest expense, it means that $21,000, okay, is the principal amount. So this is the things we have to do. So this is something like random number. You cannot make it actual number. This is random number. So let's see one example. from textbook. Let's see one exercise. So assume that ABC company issues the following installment note to Bank of Orange. So assume that, so this is our exercise 1. Assume that ABC company issues the following installment notes to Bank of Onjo. And when they issue this note on January 1st, 2020, and you have this following information. The principal amount of note $24,000. Before I said that this is the you borrow $100,000 today, right? Same question here. You borrow $24,000 today. Okay, that means you borrow this money. You borrow this money, right? You borrow from Bank of Onjo. So today you borrow $24,000 cash. Okay, today you borrow $24,000 cash from where? From Bank of Onjo. And this is an installment note. And what is the meaning of installment note? Installment note means that every year, okay, every year you have to pay similar amount of money. Okay, every year you are going to pay similar amount of money, right? Similar amount of money, and it includes some principal amount, it includes some interest expense, and after year 5 you don't have any liability, you pay all the money. So the principal amount of note is $100,000. Term of the note is 5 years. Term of the note 5 years. Okay, then we need, I told you that we need one information is about interest expense rate. We need one information about interest expense rate. So interest expense rate is 6%. 6%. We need another information. So this is the total amount we borrow, right? This is the total amount we borrow. We need another information. Which information we need? What is the annual installment payment? So annual installment payment is $5,698. This is the annual installment payment. So this is the information given to you. This is the information given to you. That means that if I copy from here, if I copy this information here, so annual installment payment is this amount. This is the annual installment payment every year. Okay, so this is the annual installment payment every year. This is the question mark. This is the question mark, and here is the question mark. Here is the question mark. And according to this question, it is 6%. So this is our question. Interest rate 6%, right? And annual installment payment $5698. So look, every year similar amount, but we have to calculate which part is the interest expense and which part is the principal amount. We have to calculate this. We have to calculate this. And here, beginning carrying value, according to this question, beginning carrying value means January 1st, year 1 or 2020. Okay, this is the beginning carrying value is $24,000. And ending carrying value December 31st, December 31st, 2025. How much it should be at the end of year 5? What is the ending carrying value? $0. $0. Yes, very good. Now you can see that in between we have year 2, then we have year 3, year 4. So beginning carrying value $24,000, ending carrying value $0. So every year later, this carrying value is increasing or decreasing. Year 2, we have another carrying value, right? Year 3, we have another carrying value. Year 4, we have another carrying value, right? Do you understand? So carrying value is different in every year. Carrying value is different in every year. So beginning carrying value 24, ending carrying value $0. Okay, and we have to calculate what is the carrying value at the end of every year. So this is the things we are going to do through installment amortization schedule. So now we are going to prepare. We are going to prepare amortization schedule for installment notes. So to do so, we have to follow some format. Let me explain the format. So we have to follow some format to solve this kind of issues. So first is about year. First is about year. So this column is year. So we have year 1, We have year 2, we have year 3, 4, and 5. Right? This is the 5 years note. Yeah, it is the 5 years note. So we have 5 years here. This is 5 years. Then the second column is about beginning carrying value, right? Second column is about beginning carrying value, and beginning carrying value date is January 1st. Okay, January 1st. January 1st. So this is the beginning carrying value. This is the beginning carrying value, January 1st. So if this is the beginning carrying value, the last column is called ending carrying value. Last column is called ending carrying value, and this is December 31st. December 31st. So try to understand this column. First, we talk about year, then we have beginning carrying value, then at the last column, it is ending carrying value, right? Yes. Then this is called annual installment payment. So annual installment payment is given in the question. I can copy here. So this is the question said that annual installment payment for 5 years is this amount. So this amount we cannot change, because the question said that every year you are going to pay. Every year you are going to pay $5,698, right? And according to this question, I told you that how much money you borrow today. You borrow today $24,000, right? You borrow today $24,000, and this $24,000 is the beginning carrying value of today, right? Beginning carrying value of today is $24,000. Do you understand? This is year 1. This is year 1. You borrowed $24,000, and this is the beginning carrying value. So $24,000 is the January 1st. So this is January 1st. This is year 1. This is year 1 beginning carrying value, right? And according to the installment note, ending carrying value at the end of year 5, what is the amount? $0. So this is year 5. Look at here. This is year 5. And ending carrying value is this amount. So try to understand this one first. So beginning carrying value $24,000 January 1st, and ending carrying value at the end of year 5, it is $0. We cannot change it, right? We cannot change it. Why? Because this is the characteristics of the installment note. The last, after paying the last installment, look at here. This is the last installment we paid, right? We paid last installment is $5,698. After paying the last installment, we don't have any liability. We don't have any liability. And this is our beginning liability, right? So this is our beginning liability. So after paying, look at it, this is year 1, right? Year 1, January 1st. And when we pay this installment, we pay this installment December 31st, right? December 31st, we pay this installment. So if we pay this installment, our liability will increase or decrease? our liability decrease. Very good. So when we pay this money, our liability decrease. But this money belongs to two amount. This money belongs to two amount. One is principal amount. Look at here. One is principal amount, and another is interest expense. Do you understand? So this amount 5698, some part is interest expense, some part is the principal amount, right? And what is the formula of interest expense? How to calculate this interest expense? The formula is beginning carrying value, okay, times rate. So this is the formula. This is the formula to calculate the interest expense. Clear? So this is the total amount. This is the total amount. If you pay interest expense, the remaining is the principal amount, right? So I can show you. Let me see, if you follow this kind of things, then it will make you easy. A. This is column A. This is column B. This is C. This is D. And this is E. It will make it easy to solve this question. Okay, so we know A is the beginning carrying value, B is the annual installment payment, C is the interest expense, and we know what is the formula to calculate interest expense. The formula is beginning carrying value, right, times rate. Now, what should be this amount? What should be this amount? So this amount, so we know this one, we know B, right? We know B, we have to calculate C. Right, we have to calculate C first. So B minus C equal D, right? So D means, so I can write here D means B minus C. We know B, we have to calculate C, then B minus C. Then how to calculate E actually? E is, look at here. This is beginning carrying value, right? Beginning carrying value minus which one? B, C or D? Which one? Because B include some interest expense, right? We interest expense is not the principal amount. So this is the principal amount. 24,000 is the principal amount, right? From here, first payment is this one. From here, we have to find out which amount is the principal amount. So this principal amount is the D, right? So B, how to calculate DE? It is A minus D, right? A is the beginning carrying value, right? A is the beginning carrying value of the principal amount. Then we pay something here. We pay something here, principal amount. We have remaining principal amount. Clear? Okay. So year one, let me solve year one first. Year one, beginning carrying value $24,000. We pay $5,698. Now interest expenses, according to this question, interest expense is $24,000 times 6% equal 1440. 1440. So we find our interest expense, right? So this is the total payment, $5,698. We know how much interest we already paid. So B minus C is the principal amount. So B minus C is the principal amount. That means the principal amount here is now 4,258. Clear? B minus C. Now this is the principal amount. This is also principal amount. $24,000 is the principal amount, right? And 4258 also principal amount. So after paying this money, what is the carrying value or what is the remaining liability? Remaining liability is 19,742. 19,742. So this is our remaining liability. Okay, and look at here, this liability becomes zero at the end of year 5. So at the end of year 1, this is our liability, right? Do you understand year 1? Any question from year 1? No. So try to understand year 1 ending carrying value. Year 1 ending carrying value is the year 2 beginning carrying value, right? Year 1, I repeat again, year 1 ending carrying value. This is the year 1 ending carrying value, is the year 2 beginning carrying value. Now we know what is the beginning carrying value of year 2. That means what is the beginning liability of year 2, right? Year 1, we already pay some liability. After paying them some liability, we start with year 2. And in year 2, our beginning liability is now $19,742, right? $19,742. Now this is our beginning liability of year 2. From here, we are going to pay 5,698. So why it is called installment note? Because every year installment amount is similar. So from this money, $5,698,000 is going to pay it. Now this money includes some part interest, some part principal amount. So how to do this? What is the beginning carrying? Because the formula of C is beginning carrying value times rate, right? So this is year 2. Year 2, what is the beginning carrying value? Year 2 beginning carrying value is this amount. Year 2 beginning carrying value is $19,742. 6% interest. It is 1,185. This is the interest expense of year 2, right? If this is the interest expense of year 2, what is the principal amount? Principal amount is 4,513. $4,513 is the principal amount. So after paying this principal amount, at the end of year 2, what is our liability? Because we already paid some principal amount, right? We already paid some principal amount. So at the end of year 2, what is our liability? At the end of year 2, our liability remaining is 15,229. So we pay some principal amount in year 2, then our remaining liability 15,229. So this is the ending carrying value of our liability at the end of year 2. Now we start year 3. So ending liability of year 2 is the beginning liability of year 3. Ending liability of year 2 is the beginning liability of year 3, and we pay this money. And from here, some part is the interest expense. Some part is the interest expense. How to calculate this expense? And 6%, it is 914. $914. We have remaining 4,784. This is the principal amount we paid. And after paying this principal amount, our liability is 10,445. So do you understand our liability is decreasing? Our liability is decreasing, right? Our liability is decreasing. So this is 10,445 is our ending carrying value of year 3. And this is the beginning carrying value of year 4. This is the annual installment payment. So what is the interest expense now? Interest expense is 627. After paying this, after paying interest expense, we paid our principal amount 5071. And after paying this money, our remaining liability is 5374. 5374, right? 5374. Now year 4 ending carrying value is the year 5 beginning carrying value, right? So we know this is the last year, and most of the students will do mistake in the last year. You understand? Most of you will have a mistake in the year 5. That means the last installment. So look at here, what should be your mistake? So year 4 ending carrying value, right? Is the year 5 beginning carrying value, no problem. We are going to pay annual installment $5698. And we know that this amount should be zero. This amount should be zero at the end of year 5, right? At the end of year 5, this amount should be zero. This is true, we cannot change it. We can't change this number, right? We cannot change this number. Why? Because this is the beginning carrying value. Year 4 ending carrying value is the year 5 beginning carrying value. We cannot change it. We cannot change this number. We cannot change our annual installment payment. It is fixed. Every year you are going to pay same money, right? So if these 3 items are fixed, then what should be the dollar amount here? What should be the dollar amount here? Because A, B, and E is fixed. A is, how much is A? $5374 is fixed. We cannot change this number. B is $5698 fixed. We cannot change this number. And we also know that at the end of year 5, it should be $0 because this is called installment note. This is the definition of installment note. At the end of year 5, it should be 0, right? So if this is the case, how can you handle C and D? How can you handle C and D? Because you have a chance to do mistake here. Here you cannot apply this kind of formula into beginning carrying value times interest rate. You cannot follow this. Now, first we are going to prove how we know it is 0 at the end of year 5. So this is the formula. Look at here. Our formula is, look at the formula. Formula is A minus D equal E, right? A minus D equal E. So what is the A here? A here is this amount. This is A, right? This is A. We don't know D, right? D is the question mark. So A minus D equal E, right? We know what is the amount of E. Amount of E is 0, right? So we know A, right? This is the A. We know A and we know E. We know this information. We know this information, but we don't know this one. We don't know this one. So if we want to make it equal, that means if we want to prove it, so how to make it 0? How to make it 0? This amount minus this amount, right? This amount minus this amount is 0. That means A and D. If A and D is not similar amount, it should not be 0, right? So A and D should be similar. A and D should be similar. So A and D is similar amount, otherwise it is not 0, right? Otherwise it is not 0. Do you understand? Now, how to calculate C? What is the formula of C? B minus C, right? Equal D, right? Now we know what is the amount of D. We know D, right? This is the D. We know D. So this is the D. And we know B. This is the B. But we don't know C. So B minus C equal D, right? So we know B, we know D, but we don't know C. So what is the C equal? So here C equal is $3 to $4, right? $3 to $4. So C should be $3 to $4. So this $3 to $4, we do some calculation and we put here. So this is called amortization schedule for installment note. So what I said, most of the students will do mistake in year 5, but this is the way how to solve the last year. Okay, how to solve this the last year. Now, based on this schedule, we have to do some journal entries. So let me show the journal entries now. So I copy it. So this is the schedule. Now we are going to record some journal entries based on this schedule. So I'm not going to show you all journal entries, only some of them. So this is date. Then accounts title. Accounts titles, then this is the reference. This is debit. And credit. So how to record the journal entries for every year. So again, I am not going to show you all journal entries. I'm going to show you year 1. Okay, I'm going to show you journal entries for year 1 and year 5. So this 2-year journal entry I'm going to show you. So year 1. January 1st. So what happened year 1 January 1st? You can see that. Year 1 January 1st. Okay. This is the January 1st. Here. Year 1 January 1st. How much money you borrow? You borrow $24,000, right? You borrow $24,000 from a bank and you issue a note. So what is the journal entry for this? What is the journal entry for this? So this amount. So the journal entry for this is you receive cash today, cash $24,000, and it is your liability. Notes payable is your liability. So you issue installment note You issue installment note. And this is your journal entry. This is year 1, January 1st. You receive cash debit, and your liability increase. Your liability increase. Your liability increase, it is credit. Okay. Now, year 1, December 31st came. Year 1, December 31st came. What you are doing in the December 31st? In the December 31st, this one. December 31st came. Look at here. December 31st came. You pay cash. Right? You pay cash. How much you pay cash? $5,698 you pay cash. And this cash includes something about interest expense, something about your principal amount. Okay. So you pay cash, some part of the cash is expense, some part of the cash is your liability. You understand? So here we paid cash this amount. We paid cash this amount. This amount is for interest expense, and this amount our liability decrease. So December 31st came. We pay cash. We pay cash this amount. Cash decrease, now credit. We pay cash $5,698. And this $5,698, some part is the interest expense. And you know that expense increase debit, right? So how much expense our increase? This is the expense increase for year 1. Interest expense debit. And this is the amount of liability decrease because you pay cash, right? You pay cash, some of your not all liability, some of your liability decrease. So when your liability decrease, this is the journal. Notes payable, look at a liability increase credit, and notes payable, liability decrease debit. Liability decrease debit. So how much liability decrease at the end of year 1? At the end of year 1, this is your liability decrease. Paid interest expense. And installment note. So you paid some installment about note and you pay interest expense. Now I'm going to show you journal entry for year 5. So if you understand year 1, okay. So year 2, year 3, year 4, year 5, all are same. All are same. I'm going to show you only year 1 and year 5. So this is year 5. Year 5, December 31st. Okay. Year 5, December 31st. What is our last installment? This is our last installment, right? This is our last installment. So this is our last installment. And this installment include some part of the interest expense. Which one? This one. Some part of the interest expense. So interest expense. And it includes our liability. Include our liability. Yes. So this is year 5. Okay, this is year 5. and this is year one. This is year one. So year two, year three, year four, same. I'm not going to show you all the journal entries. Clear? Year 1, 2, 3, 4, 5, December 31st, same journal entry. Clear? Okay. So in the exam question, I may ask you to prepare the schedule. Okay, to prepare the schedule and record journal entries for year 1 and year 5. Okay, so maybe this is your question. So this is the question. Okay, this is the question and requirement. Requirement 1. This is the requirement 1. Prepare amortization schedule. Okay, prepare amortization schedule for installment note. Requirement 2 may be record necessary journal entries for year 1 and year 5. Okay, so it might be your question like this. So in this case, this is the requirement 1. This is the requirement 1. You prepare this schedule, right? And this is anyway. So this is requirement 1. And this is requirement 2. So requirement 1 and 2 done. Now I'm going to show you how to prepare the balance sheet. So balance sheet equation, you should know the balance sheet equation. So what is the balance sheet equation? Balance sheet equation is assets equal liabilities plus assets equal liabilities plus stockholders equity. So this is the balance sheet equation. This is the balance sheet equation. As a business student, you must know this. Balance sheet equation is the asset equal liabilities plus stockholders equity. So this is our chapter. So this chapter is about liabilities, right? As this chapter is about liabilities, when we prepare balance sheet, how we handle the liabilities information I'm going to show you. So I'm going to show you how to prepare balance sheet, only liabilities side. For example, this is ABC company. This is the name of the company. What we are doing balance sheet. and balance sheet is prepared on a specific date. So something like December 31st, maybe 2022. So this is the title of the financial statement. And I am going to show you only this part because we are handling this part at this moment. So I am not going to show you how to report asset. I am not going to show you how to report stockholders' equity. I am going to show you only how to report liabilities, right? So our title here is liabilities. Our title is liabilities, something like this. So we have two types of liabilities. One is called current liabilities. Current liabilities, and we have another part is called here, long-term liabilities. So what is the difference between current liabilities and long-term liabilities? Can you remember? Yes, so this is the short term. Current liabilities is the short term. That means the duration is less than 1 year. You are liable to pay this money less than 1 year. And long-term liabilities means it should be more than 1 year, maybe 5 years, 10 years, 20 years, something like this. So what are the examples of current liability? So first one may be accounts payable. Accounts payable is our current liabilities. Then notes payable. Sometimes notes payable also, sometimes notes payable. So notes payable sometimes current liability, notes payable sometimes long-term liability. Okay, it is more than 1 year. More than 1 year. So notes payable, I repeat, sometimes current, sometimes long-term. Okay. Then maybe we have salaries payable. Maybe we have income tax payable or interest expense payable. So interest payable, or it may be income tax payable. So I can put some random number. Like 133,000. Then maybe 200,000. Then maybe 42,000. 16,400. 40,000. So total current liabilities. So 431,400. So this is the example of current liabilities. Okay, accounts payable, notes payable, salaries payable, interest payable, income tax payable, and total liabilities. Now look at the long-term liabilities. So these things you also learn from your principles of accounting 1. right? I am just going to repeat something. So principles of accounting 1, you also learned this. So current liabilities, total current liabilities, then we have long-term liabilities, notes payable, also long-term liabilities. Okay. So maybe this is $1 or $300,000 anyway. Now we know that bonds payable is our long-term liability. Okay, so maybe bonds payable is $500,000, for example. Then if we have any unamortized so for example $100,000, and I can copy this for another one. Unamortized premium on bonds. So try to understand this too. Yes. So now let me tell me that bonds payable $500,000, bonds payable $500,000, and we know that bonds payable normal balance. We know that bonds payable normal balance is credit, right? Bonds payable normal balance is credit. So bonds payable normal balance credit. Now unamortized discount on bonds payable. What is the meaning of unamortized discount of bonds payable? It means that we just record discount. We have not yet transferred this discount to the interest expense. Okay. Can you remember? Discount and premium are the additional interest expense. Discount is going to add, can you remember? And premium is going to deduct with interest expense, right? So we have discount on bonds payable, not yet transferred to interest account. And we have premium on bonds payable, not yet transferred to the interest account. Okay. It is unamortized. Now, what is the relationship between these two? What is the relationship between bonds payable and unamortized discount on bonds payable? Their relationship is positive or their relationship is negative? What is the relationship between discount and notes payable? Last class, I explained you how to calculate the carrying value of the bond. This is the balance sheet, right? This is the balance sheet. How to calculate the carrying value of the bond. If it is a discount bond, it is a premium bond. Last class, I explained. So what is the normal balance of discount? What is the normal balance of bond discount? Debit or credit? Debit, right? So the normal balance of unamortized bond discount is debit, and normal balance of bonds payable is credit. So what is the relationship? The relationship is less, negative. The relationship is negative. That means this $100,000 is going to deduct, right? This $100,000 is going to deduct from bonds payable. Clear? Then the carrying value. Then the carrying value of the bond here. The carrying value of the bond here is 400,000. Okay. Now, if we have an unamortized premium on bonds, so bonds payable normal balance credit, and what is the normal balance of unamortized bond premium? What is the normal balance? It is also credit. Okay, credit and credit plus. So add $100,000. Now it is $600,000. Clear? So this $400,000 is the carrying value. This $400,000, $600,000 is the carrying value. So if it is a discounted bond, okay, If it is a discounted bond, if we have any unamortized amount, then the relationship is negative. Okay. And if we have any unamortized premium bond, their relationship is positive. Okay, this relationship is positive. And what is the meaning of unamortized? It is the real amount. You haven't transferred this amount to the interest expense. Okay. So this is about how to prepare balance sheet, the liability side. Liability side. So we have current liabilities, we have long-term liabilities, and this is the way to present the balance sheet. So this is all about this chapter. Next class, I will start another chapter titled Accounting for Corporation. Okay, do you have any question? Okay, that's all for today.